Hey, good morning once again, options traders. Well, I thought it might be really helpful for our new traders out there to talk about the controlling strike. And this is particularly helpful for vertical spreads, as we'll find out. It can also help you with diagonal spreads. So, what is the controlling strike and why does it matter? Well, let's go take a look. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is always greatly appreciated. So for starters, let's back up. Remember what a vertical spread is. Well, it's a strategy where you're going to, let's say, buy a call or a put, and then you will sell a call or a put at a different strike. Now, it's important to understand that they both have to be calls or they both have to be puts. You can certainly do the buys and sells with different assets, but those are different strategies. But for a vertical spread, they're both calls or they're both puts. They have to be the same underlying stock and the same time to expiration. So for example, let's say that you buy the $100 call and sell the 105 call. So one of the things that traders struggle with is to determine if this is bullish or bearish. And too many times they just resort to saying, I've just got to memorize it. So this is where the controlling strike will come in. Before we talk about that, let me show you a simple way, again, just for all of our new traders. It's a little bit more of a mnemonic device, but all you have to remember is buy low, sell high. Doesn't get any easier than that in the stock market. So buy low, sell high looks like BLSH if we just use the letters there. And of course, BLSH looks like the word bullish. So if you're buying the low strike and selling the high strike, it is a bullish position. So for example, let's say that you buy the May $100 call and sell the May 105 call. You're buying the low strike, you're selling the higher strike, and so that is going to be a bullish vertical spread. You could also look at it with puts. Let's say that you buy the July 300 put and sell the July 310 put. All you have to do is say which strike are you buying and which are you selling. We're purchasing the lower strike. We're buying the 300, we're selling the 310. So it doesn't matter if these are calls or puts, this little mnemonic will always work. Buy the low strike, sell the high strike, it is a bullish position. Once you learn that, understand that flipping it is going to make it bearish, because that would just be the trader on the opposite side. So if you buy the high strike and sell the low strike, it's bearish. All right, so that's a simple way to get started and to understand it, but to really understand what's driving these strategies to become bullish or bearish, you have to understand the controlling strike. And to understand that, we have to first talk about some pricing principles. And I believe we've talked about these before in previous videos. There's a lot of different pricing principles with options, certain relationships that have to occur in the markets. And a very powerful one to know is that lower strike calls are more valuable than higher strikes. And as a corollary, higher strike puts are more valuable than lower strikes. This, of course, assumes that we're talking about the same underlying stock and expirations. So for example, let's take a look at the May 100 call and the May 105 call. So because these are calls, we just look for the call that has the lowest strike. It is the 100. So we know that this option absolutely must be worth more money. Try it on your broker's platform. Pull up any expiration date, and you will see that the lower strike calls will be worth more money than the higher strikes. There's what's called an arbitrage, an opportunity to make a risk-free profit for no cash outlay. Kind of like too good to be true, but that's what would set up if this were reversed. So we know that the $100 call has to be worth more money. What about with puts? Well, with the puts, the principle says that higher strike puts are worth more money. So we look at the two strikes here. We've got the 310. That's the higher strike between the two. So I know that this option must be worth more money. And once you've identified the more valuable strike, that is going to be the controlling strike. That is what dictates whether the strategy is bullish or bearish. So for any vertical, the lower strike call or the higher strike put will determine whether it's bullish or bearish. And this is really the better way to understand it, because as you become more advanced, you might leg into vertical spreads. You might split them apart. You might hedge, roll, and morph by using vertical spreads, and you might end up inadvertently going into a bullish or bearish position because you didn't understand the controlling strike. So to understand whether it's bullish or bearish, it's really a two-step process. It's really just that simple. Step number one is to identify the more valuable strike in your vertical spread. And then step number two, identify if it's long or short. And the nature of that individual position, the more valuable strike, is the nature of the overall position. All right, so that sounds a little confusing, so let's take a look at a couple of examples. Let's say that you buy the $100 call and you sell the 105 call. We would say that you're long the 100-105 vertical spread. So the question now is it bullish or bearish? And of course, we could fall back on our buy low, sell high mnemonic, and we could say, all right, this must be bullish. We're purchasing the lower strike, selling the higher strike. But the better way to understand strategies is to figure out which is the controlling strike. So we've got call options in this. We know that the lower strike, the 100, is the more valuable position, and therefore it's the controlling strike. So that's step one, identify the more valuable strike. Step number two, figure out if it's long or short. We are buying this more valuable position. So what's your outlook when you are buying calls? Well, you're bullish. And because of that, the entire vertical spread must be bullish. This position down here, the sale of the 105 call, is a hedge. So for example, here's the resulting risk graph that we would get. So over here is the long 100 call. There's our hockey stick graph. But the hedge is over here. That's what gives us this flattened out portion. So why did we do this? Why did we sell this 105 call? Well, had we not sold it, we would have spent a lot more money on the 100. So the reason for the hedge is that we wanted to shift this maximum loss to a lower position. So maybe this $100 call costs $10. And if we bought it by itself, it would cost us 10. Well, maybe we could sell this 105 call for 7. So if we spend 10 and collect 7, on a net basis, we have spent 3. So that's where the hedge is coming from. It's reducing the amount of money that we have into it. And of course, there's a cost for that. The cost is we no longer have unlimited upside. But the reason that the overall position is bullish is because we have purchased the more valuable call. It is the controlling strike. Okay, so let's try another one. Let's say that you buy the 105 call and sell the 100 call. This time we flipped them. You've got the 100-105 vertical spread, but this time it would be short. So the question is this bullish or bearish? So as before, it's a two-step process. We see that we have calls, which is the lower strike. It's right here, it's the 100. So that's the first step. I've identified the more valuable strike. Step number two, what am I doing with it? I am selling it. What's your outlook if you are selling a call? Well, that by itself is bearish. And therefore, this entire spread must be bearish. The purchase of this 105 is simply done as a hedge. So if we were to sell this 100-105 vertical spread, this would be the resulting risk graph. There is the sale of the 100 call. That's what's making it bearish. But we would also have this unlimited risk if we just sold this $100 call by itself, and we don't want that. And because of that, we purchased this 105 call. There's our hedge. That's what flattens us out. So as always, if you're not willing to take as much risk, you're going to have to receive a smaller reward. And that comes from the fact that we have to buy the 105 call. We've had to shell out some additional money. If we just sold this $100 call by itself, we would have a bigger credit, and that's the maximum we could make. And so we're now reducing the amount we can make because we had to buy this 105 call. The benefit is we have now gotten rid of this unlimited upside risk. So it's very easy to determine if a vertical spread is bullish or bearish by simply determining the controlling strike and then figuring out if that is long or short. Okay, so now that you understand the basics, we can also use this for diagonal spreads. Position that's a little more complicated. Let's say that you buy the April 220 put and sell the January 210 put. Well, is this bullish or bearish? Well, these are puts. What's step number one? Identify the more valuable put. It's the 220 strike. Now, interestingly, for diagonal spreads, we don't have to worry about the expiration dates because the 220 put still dictates the nature of this spread. Step number two, what are we doing with it? We're buying it. What's your outlook if you're buying a put? It's bearish. And because of that, we know that the overall profile for this diagonal spread must be bearish. So if we look at it, there it is. This little crown right here, this maximum gain, is in this case, the 200 put that we're short, and our long 220 is out here somewhere. Now, the reason we're not getting that nice angle, that little elbow that we usually get, is because this one hasn't expired. The longer dated option is still in play. The shorter dated option is at expiration. That's what's giving us this graph. Now, there's a certain caveat that you have to be careful of when we're using diagonal spreads. And sometimes traders don't understand that this has an overall bearish outlook. And the way that you can see that is give yourself two choices. If you could allow the stock to, let's say, go to the far left side or all the way to zero, or the stock could go all the way to the far right side, or 300, 500, some really high number. Which would you choose? Well, we'd rather have it go down. This is where the bulk of the profits are on this end of the graph. So that's why overall it's bearish. Another way you can see that is just to connect, let's say, the far right side of the graph to the far left side, and that imaginary line is leaning left. It's bearish. So overall it has a bearish viewpoint. But where traders get confused is they might see that there are certain pockets where that's not true. So let's say the stock is around here from maybe 80 to 200. Yeah, you've got positive deltas in here. So if the stock is 180, sure, all things being equal, you'd rather see it rise and start moving up to this peak. So yes, you do have positive deltas there, but you also have negative deltas over here. So you do have to be careful. Yes, certain areas of the graph can have positive deltas, and therefore we might call it bullish. Other areas might have negative deltas, in which case we would say it's bearish. But overall, it has a bearish view or a bearish bias, and the reason is we have purchased the more valuable put. All right, so why is this important to understand? Well, remember, as you hedge, roll, and morph, you can unintentionally switch the directional bias. So for instance, let's say that you buy the $100 call, but at a later time you sell the 95 call. For some reason you've decided to hedge, maybe implied volatility has spiked, and you want to sell the 95 call. In your mind, you're thinking, all right, it's the at-the-money call, the stock has fallen, let me sell the 95 call. So a lot of new traders will say, well, I've bought a call, I've sold one, it's a bullish position. Well, it used to be bullish, but it's no longer bullish. So what happened to the directional bias? Well, again, here is your long call that you started with, but as soon as you sell the 95 call, you switch to this. Now, that might be intentional, and that's again the power of options. We might collect a premium to switch our directional bias. We might get ourselves into a situation where I can get all of my cash back and shift this curve above zero. But you have to understand what you're doing and why. So this is a really good way, if you're not putting on a spread at one time, this is where traders get into trouble. And a very easy way to figure it out is to understand which is the controlling strike. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.